What's up, everyone? Dylan here. I wanted to hop on to go over some of the key macro technical areas that I will be looking at going into the next 3 days. The next 3 days will be very important as some key economic numbers will be surfacing. Starting tomorrow, which is Wednesday, March 12th, we have CPI at 8:30 a.m. Eastern Time, followed by Thursday, PPI at 8:30 a.m. Eastern Time, and then Friday you have consumer sentiment at 10 a.m. Eastern Time. All of those numbers have the ability to influence overall sentiment, especially in today's environment in the market, because the market has been moving lower on stagflation concerns. So these numbers will help get a more, up-to-date view as to whether these stagflation concerns are increasing or easing. So what I'm going to do is mark the macro areas on the chart, and then going forward, I'll talk about some tips that will help everyone utilize these specific levels. Okay, so a lot of these I've talked about already. I'm going to start and go ahead with the critical trend line stemming from October of 2023. Okay, this is a level that I've talked about. On top of that, I also want to go over the key technical level on the cash index on the S&P, which is 5672. So I'm going to go ahead 5672, and to make it simple, first off, I wanted to say that this is a key area as it was once all-time highs, and then it acted as key support on the retest. Right, and then as you could see, there was a point in time recently that specific line acted as key support as it bounced there on Friday. Okay, but like I said, to keep this very simple and easy to follow, I'm going to make all of these on the S&P 500 futures, just so you're not going back and forth to different instruments. Okay, so we have the critical trend line from October of 2023. We also have the 5672 equivalent on the futures, which equates to 5680.25, right? On top of that, we have a line that I pointed out in the Discord today. Okay, the line is 5550. Okay, the reason for this specific line is a percentage play, I should say, right? What do I mean, right? From the highs, the recent highs, to 5550, it represents a 10% drawdown. And the textbook definition for that is correction territory. So anytime a instrument, index, futures, whatever you're looking at on a chart, anytime that specific instrument drops 10%, it enters into correction territory. Okay, so oftentimes a lot of people will be looking at that specific correction territory area, right? It's on the news. You'll see it on CNBC, people talking about, oh, the S&P came into correction territory, right? With a lot of eyes on it, there's built up psychology around that line where people will try to defend it, okay, usually. So I'm going to go ahead and mark that as correction territory. And then one more below that, right, slightly below that, is here, which is the previous swing low from September 6th, okay? And if things get really ugly, I'll do one more, right? We'll go ahead like this. This is one more line that will be important. This represents an area that has been tested numerous times, not only resistance, right, another resistance here, but then since January of 2024, it has acted as support 3 different times. Okay, so that one you got to kind of think outside of the box, as it's not a horizontal level. You kind of got to dig for a line like that, but it does, it does have a lot of influence and significance, as it has proven to work 5 different times over the last, what is that, from July 2023 to August 24. So over a year worth of tests that very, very clearly pivot at that general area. Okay, so this is what we're working with, right? We have the critical trend line stemming from October 2023. We have the 5672 equivalent level from the cash. We have the correction territory, which represents a 10% drawdown in the S&P futures from highs. And then you have that last trend line as well, okay? So with my style of trading, I predetermine key areas that I form hypothetical scenarios around, okay? A very, very common flaw that I've been seeing, especially in this volatile market, is people chasing moves that already have moved, say, 30, 40, 50 points, right? People who have FOMO and the constant desire for action, they trade based on impulse, right? They'll see a massive move already occurring, and what do? They chase after it because they have the fear of missing out on a potential breakout or breakdown, okay? And by doing that, you're entering in an area that has very, very poor risk reward, as you're basically trading a move that does not have a clear edge present. And by doing so, by you chasing, you're not preparing to be able to manage that trade properly. Okay, so whereas my methodology is picking out key macro areas that have proven to be important in the past based on historical price action, coming up with a clear plan around it ahead of time, just so I know once it does test that general area, I have an actionable trade idea to capitalize on without second guessing or being overwhelmed trying to come up with a plan on the fly, okay? So what I've been noticing a lot of people doing is chasing breakouts to the upside and then initiating shorts on breakdowns after extended moves to the downside, okay? So I wanted to talk about this briefly and then go into some key examples of what I'm talking about, okay? So today at 1:43 p.m. Eastern time, I said 5550 to 5528.75, which I've drawn on this chart, is a key area which represents the correction territory down to the swing low from September 6, 2024. Usually, an extended move into a psychological drawdown percentage can act as solid support, okay? So then I said, from a pure risk-reward standpoint, the best way to play this market, this current market, is by selling rallies and covering at key macro supports. Okay, and then I talked about both times I've tried longs in the last week and a half, stemming from February 27th, we're able to, produce rallies, right? Why is that? These are areas that are, basically vetted, right? I'm not picking a mediocre random level based on me just seeing price moving in a fast momentum manner. No, I am picking out key areas that I know have proven to be very, very, high, highly influential. And I am speculating that going forward, an extended move into those areas will produce a move off of them, okay? So these aren't some random levels that I'm just, picking out of a hat, okay? These are predetermined areas based on my technical strategy. So I said initiating shorts on extended breakdowns is not an ideal entry. It's better to wait for a relief bounce back into the resistance to initiate, right? There's better risk reward. By you chasing a breakout after it's already gone 30, 40, 50 points in that way already, or by shorting, right? Initiating a short on a breakdown, an extended breakdown that has already been falling 100 points, 50 points, so on and so forth, you're leaving very, very, very small room for error. So unless you get a flawless entry in terms of timing, with the volatility that we've been seeing in the current market, right? It's very, very, very difficult to capitalize on those extended moves, is all I'm saying, right? Because your stop loss probably isn't going to be able to swallow a 20, 30 point move against you. So by pre-planning these areas well in advance and looking at how price reacts to those areas, it can give you a much, much clearer and more defined area to use as a stop loss. Okay? So I was basically implying that initiating shorts into that area, right, that 5550 to 5528 area is low quality. It is better to wait for a move into resistance to short as opposed to initiating on a breakdown. And as you could see, for the folks who, tried to say, initiate a short under the low of day, it didn't last long as it came into this predefined area, right? And bounced very, very nicely. So going forward, this is what I wanted to talk about, okay? It is way better in this current market environment to short rallies at resistance as opposed to shorting breakdowns. And what do I mean by this? Right? I'm going to use the exact lines on my chart to give you guys a clear example of what I'm talking about. Okay? The first one was using the macro critical trend line stemming from October of 2023, right? I was mentioning this level well in advance before it came down and tested it on Friday, February 28th, okay? What I'm saying not to do is to short a breakdown into a key macro support. The risk reward is very, very, very terrible, okay? It's horrendous because you're essentially shorting an already very extended move when, say, RSI is oversold and there's a lot of different metrics that are lopsided where it doesn't take much to flip that sentiment and trap late shorts into a very, very important macro level that has proven to be an influential one. So by shorting right above that macro area, you're basically asking to lose, right? The risk reward is non-existing, right? You're betting that you're relying on the fact that it needs to breach below that macro support area, which just, I would not bet against that after an extended move, okay? Instead, I would wait for the breakdown to occur and then wait for a retest back into the area, okay? Not only did it retest that one time, but it also got pretty close a second time as well, right? By shorting this move on the retest back up there, you are clearly defining your risk where you could have a clear invalidation point to use as your stop loss with some nice projected reward potential to the downside, okay? So by predetermining a significant area, you can go ahead and hypothetically come up with a scenario so that once it tests, you know exactly what you're going to do and you have a clear game plan to capitalize on, as opposed to just coming up with this on the fly. Okay, so that's the importance of coming up with a significant area ahead of time, waiting patiently for that area to get tested, and then following your predetermined plan that has predetermined risk-reward calculations around it, okay? Going forward, as opposed to shorting the breakdown, say below 5690, heading into this key 5680.25 area that stems from that support on the cash index, right? It's better to wait for it to potentially bounce and then either short a rally into a previous area of resistance, right? If you shorted this area, which was the high of day from the pre-market session, right? you could have easily shorted that rejection at that previous high, and you could have easily had very, very tight defined stop loss, okay? As opposed to shorting a breakdown after an extended 180 point move to the downside into a key support, right? The risk reward is not good. So it's better to wait for a rally up to a predetermined resistance area where the risk reward is much, much tighter, okay? Or if you didn't want to short that one, you could have waited for the breakdown, and guess what? Shorted the retest back up, okay? So it broke down, and guess what? It came back up, retested that key 56.72 equivalent level, and then sold off. So you could have waited for the retest, shorted the retest, clear invalidation point stop loss above, and then you had a nice wide area for a projected reward. Okay, so going forward, I would not recommend shorting into this correction territory between 5550 and 5528. Instead, I would wait for the breakdown to occur and then potentially use that area as a potential area to short going forward. Okay? And maybe you don't get the retest, and then going forward, if this next macro area gets tested down here, right, around 5415, I would not recommend initiating shorts very close to that trend line, because chances are it's proven itself to work 5 times already in the past, and after a very extended move already into that, shorting in that area, right, shorting price into that area, very close to that area, you're asking to get stopped out, because you're like I said, you're leaving very, very small margin of error, right? And you know, it's the risk reward is horrendous. Okay, so it's better to wait for these areas to break down and then retest, as opposed to initiating on sell-offs. Okay, so let's say the next 3 days are very, very volatile, right? Say we do bounce up from this correction area. I would then look to see if that 5672 area gets retested. Okay, on top of that, you could also use this NASDAQ area as well, okay, because this area has not been retested. You got a nice bounce on it on Friday, as I talked about in my last video, and then since the breakdown occurred, we have not retested this area where previous support can be, you know, you can gauge if it turns into resistance on the retest, okay? So same deal with that 5672 equivalent, okay? If this general area fails and then we head into that area, then I would imagine that it's going to bounce there for a retest back up to that correction territory, okay? And then if the correction, or if this trend line breaches, my next level would be the previous swing low from August 5th. So this is what I have in terms of where I will be looking at engaging price action around over the next 3 days and beyond that. A lot of the in-between action, right, when the price action is in between these key areas, it's either I'm in an existing trade and I hold patient until the next area gets tested, or I just patiently wait for the next area to get hit, and I really don't do much in between those general areas unless new pieces of confirmations and technical context arrive. So hopefully that makes sense. Hopefully if you have found yourself chasing breakouts and chasing breakdowns that clearly have been very, very, very difficult to manage, try to use this general methodology of looking at a macro visual, picking out key areas on the technical macro point of view that have proven to work in the past, and look at those general areas to gauge price action around, and to come up with hypothetical scenarios around them where you predefine areas of entry, exits, and so on and so forth, so that you know exactly how to manage these trades and manage the risk around them ahead of time. You need to be one step ahead. Okay? That's it for me. Peace.